Time to get started. We're going to talk about inflation, and we're going to look at inflation rising and falling inflation environments. So let's take a look at that. And basically, from this, we're going to try to understand how we can position our portfolio. So let's look at this in a little bit more detail. 1 second. So first, the topic is rising inflation expectations and the impact on asset classes. So I'm opening it up for any questions that you may have about inflation and what asset class you should or should not be allocated to. That's part of what we're talking about today. But before we get started, let's kick it off by talking about what I consider to be the article of the day. And that is that the company Apple buys a company every 3 to 4 weeks. This is an interesting article that came out that basically talks about how crucial acquisitions are for Apple's success. Over the last 6 years, Apple's acquired over 100 companies, and acquisitions are mostly aimed at innovations and talent. Now, when I looked at this particular news article, it made me go back to the data that I have on Apple versus global tech companies. And you can see that the global tech companies have a net interest margin of about 7.6, whereas Apple's net margin is about 21.6. So Apple is achieving a much, much higher level of profitability. And one of the ways they're doing it is instead of spending on R&D, they're spending a lot of money on acquisitions of companies to gain their knowledge. Apple acquires companies for features where it has weaknesses, not strengths. So usually Apple doesn't buy direct competitors. Instead, it focuses on smaller, innovative companies that develop the most advanced technology in their niche. And that's how Apple does it. So let's now get into the topic of the day. The topic of the day is, what can we learn about inflation expectations from the TIPS spread? And we're going to talk a little bit about inflation. And rather than looking at inflation levels, we're going to look at inflation rising or falling. And so when we do this, we have to first look at TIPS. TIPS are Treasury inflation protected securities. They're bonds that are linked to inflation, and they protect against decreasing purchasing power. Basically, you're protected against inflation if you buy a TIPS. Of course, the US is the major issuer of TIPS, although many other countries have TIPS instruments now. Now, the difference between a Treasury bond and a TIPS is that ordinary Treasury bonds do not provide inflation protection. If interest rates go up, then these bonds fall in value. But that protection exists with TIPS. Now, the spread between both of these securities represents the market's current expected inflation. So what is the calculation? Expected inflation equals the Treasury yield minus the TIPS yield. Now, right now, the Treasury yield is at 1.29, and the TIPS yield is almost -1. It's minus 0.87. So that spread is 2.16. Let's say about 2% expectation for inflation. So right there, we can see that the market has built in some inflation expectation. And if we go into this, we can actually look at it going back to 2003 to try to understand what this relationship has looked like in the past. Now, on average, the TIPS spread or the inflation expectation has been about 2%. In 2015, as well as in 2020, inflation expectations went negative. But recently, inflation expectations have just started racing up, and they've now exceeded the 2% average. What does this mean? Well, if inflation starts to rise, you've got a problem for the federal government in the US. They have so much debt that if the inflation rate starts to rise, what's going to happen is US government bond yields are going to have to rise, And as US government bond yields rise, that means the cost of funding the US deficit is going to rise. And already the US deficit is massive relative to all spending that the US government does. So if this interest rate rises, let's just say that the government bond rate goes from 1, or let's say on average, the government is paying probably 1%, maybe 0.75, because a lot of their funding is short term. But you can say, let's say 1%. If the government bond rate goes from 1% to 2%, you've now doubled the interest expenses that the US government has to pay. And that is going to crowd out spending in other areas like social programs and things like that. For this reason, it is very likely, in my opinion, that the Fed will come in and actually control the yield curve. This would be yield curve control, where they just do not allow the yield curve to go over a certain level. And I think that that's very possible that we move into this situation, because it's going to be hard for them to allow it. So already we're seeing inflation rising. So the question is, how much longer? Inflation can rise, but if bond yields are not allowed to rise, then bond investors aren't going to be compensated for the inflation. So what impact does inflation have on different asset classes? Well, we investigated the total returns of the asset classes during different inflation environments using monthly data from January 2000. We first looked at accelerating inflation environments, which means that there was a positive change in CPI. And usually what we're looking at is over a period of month on month, this month compared to the prior. A decelerating environment stands for negative changes in inflation. So what were the conclusions that we came to? This chart, which I'm showing in the video, is showing that if we are in a rising inflation environment, then commodities is the main beneficiary. And if we're in a rising inflation environment, stocks are the second beneficiary. In fact, gold would be third. So stocks and gold actually are pretty close. But if you can time it right, then commodities will be a major source of return in an inflationary environment. So the point is also, for those people that are following our AWS portfolio at Phenomenon, they'll start to see that we have had some allocations to commodities and we're getting some benefit to that. All right, let's wrap it up. Let's look at the meme of the day. This meme is a pretty funny one that says bubbles. No one can really identify them, and that is Chairman Powell. And basically the joke is that, of course, everybody can see a bubble happening. All right, what's the key points in the bottom line? Well, Apple makes very strategic investments to buy technology in areas where they're weak. As far as the research topic, well, inflation expectations are on the rise, as indicated by the increasing TIPS spread. Commodities provide the highest returns during high inflation environments. So the bottom line is, consider to add commodities to the portfolio. Finally, I'll wrap it up by saying, if you want to see how I pick stocks, just download my free checklist by either scanning this QR code or by taking a picture of it and then loading it up into your computer and going to it. So that gives you some background on the concept of inflation and rising inflationary environment. If you have any questions, as I said in the beginning, you can always include them in the Slack or in the chat. So Hillary, good to see you. My friend Patrick really likes your comments on Facebook. He thinks you're very thoughtful. That's nice. CV Thomas says, do you buy silver? Well, I think in a rising inflationary environment, we already saw that gold does benefit. The question is, to what extent will silver move with gold? The general answer, I would say, is yes, silver should outperform in a rising inflationary environment, but we would have to look at it a little bit more closely about the relationship between gold and silver in this environment. We only tested gold. So it's actually a good one to think about, looking in more detail of the difference between silver and gold in an inflationary environment. All right. Well, I want to thank everybody for tuning in, and keep your questions coming if you've got any more. then I will do my best to try to answer them. Marianne says, do you use fundamentals or technical analysis or both? Marianne, what I use is what's called FVMR. And FVMR is my combination or matrix that I look at, which is fundamentals, valuation, momentum, and risk. So to answer the question, I do look at both fundamentals and technicals, because I learned many, many years ago that sometimes some stocks can look like they are fundamentally cheap, but you end up getting involved in a value trap. And so in order to avoid value traps, I like to look for stocks that are cheap and have some momentum. Steve Thomas says, do you invest in crypto? Well, I'm very careful about crypto. And my answer to that right now is to be very careful about crypto. It's potentially in a massive bubble, or it could be the next thing for decades to come. The result of that is that if I look at crypto myself, my feeling is that a 1 to 3% allocation of your overall wealth may be okay, depending on your current situation. Yep, Marianne, you're welcome. All right, so the question is, do we have an inflationary or a deflationary environment? In some cases, you could say, well, the bond market is basically showing us that there's not that much inflation in there. And also we can say that the Fed has already said that if inflation exceeds the average, they're not going to worry about it too much. They're going to let it go. So I would say, in my opinion, we're going into an inflationary environment, and therefore, whether it's crypto, whether it's gold, or whether it's commodities, I think that there's an argument to consider investing in all of those. But I would just say that these are not the most standard of asset classes. So be very careful not to overweight those particular asset classes. And I think I will leave it at that. And I want to thank everybody for listening, and keep your questions coming.